Hello traders, the title of the video is Stock Market Trader explains the signature of the bearish traders. What is the signature of the bearish traders? Okay, there's one here. The signature of the bearish traders, in my view, feel free to disagree, is the double top. Alright, the double top chart pattern is the signature of the bear. So you may say to me, George, you're going to annoy me now, I'm going away. But I will encourage you to watch the full length for this video because I'm going to keep it short to 8 minutes video. Alright, so I encourage you to watch the full length for this video. I have not finished yet. So what we are looking for a double top with a surge in trading volume. That's all. That's the signature of the bear. Now we can talk about other chart pattern, bearish chart pattern, like a head and shoulder chart pattern, alright, and a surge in trading volume. That's also true, but personally I would like to talk about the double top and the surge in trading volume that is occurring on the right hand side. Okay, top here, you see I talk about the double bottom chart pattern with the surge in trading volume on the right hand side low. Remember that video? I recorded that video recently, and those are the videos that are called the focus videos. Alright, right from a double bottom chart pattern, and we see a surge in trading volume on the right hand side low. That's the signature of the bullish traders. When we have a double top and we have a surge in trading volume on the right hand side high, you see it's equal high here. You see a surge in trading volume at the right hand side high. That's the signature of the bear. So you say to me, George, I had enough. I encourage you one more time to stay with us. So how do you trade the signature of the bear? Very good question. So what usually takes place, alright, there is a group of traders that decided to sell the stock, okay? So usually those are hedge funds or big financial institutions. They are the first one that will establish the trend. For traders who understand the Elliott wave, I usually say to traders when I'm talking about Elliott wave at a 2-4 Elliott waves YouTube channel, I usually say to traders that the first Elliott wave in an uptrend is the signature of the bull, and the first Elliott wave in a downtrend is the signature of the bear. Alright, that's what I usually say when I'm talking about Elliott wave. Alright, because those hedge funds and big financial institutions will establish the trend. Without them, you're not going to have any trend at all. So what we are looking for, as we see the signature of the bear, probably form a double top and the surge in trading volume on the right hand side top. Right, this one here, this is the first top, this is the second top, the right hand side top. We see a surge in trading volume in that point in time. Sometimes, what usually takes place, traders who recognize this pattern, that's why I said you should watch the full length for this tutorial, they will start selling. Right? Sometimes they are even taken out of the trade because they don't time the market correctly, and they are taken out. Right? Blah 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 blah. Price went up, blah blah blah, and they are taken out, and they give up, and they walk away, and they forget about it. Or they don't even want to know about that double top chart pattern and the surge in trading volume anymore. But what you can do, alright, if you don't want to lose, or you want to adopt a conservative approach to your trading style, what you can do, once you identify the signature of the bear, you say, alright, they are selling. I will sell only if I see the first lower high. You can do that. So this is the signature of the bear. The bear are selling. They see the double top with the surge in trading volume on the right hand side. You know that they are selling. So you say, all right, I'm not going to ride. All you can do, you are conservative, right? You can just wait for the first lower high. Here it is. This is the first lower high after the signature of the bear. And then when you see that, this is a beautiful one here because of the price structure. You see 1, 2, 3 minimum price move is free, and now we have, okay, that lower high and this common central line is kaput. So we have a lot of confirmation happening here. minimum price move is free, and now the common center is coupled, the price forming the first lower high after the signature of the bear. So you can sell after you see the signal of the bear, look using a top-down trading method, selecting a very timely entry point using a top-down trading method. If you think that it's going to be messy and you don't know how to handle it, you can adopt a conservative approach, which means you will wait for the first lower high. But you need to be very careful because, as you can see here, after the signature of the bear, we see that the price formed this top here. Right? You want to see a clear-cut top, meaning that the price, the common center is coupled, one candlestick bar is down, and then you implement a top-down trading method to sell it. But what you are looking for is that after the signature of the bear, remember this, you want a rally, you want a price to go down to form a new lower low, which is the case here. So here we have this low here. Now it's very, very important for us that if the signature of the bear is a valid signature of the bear, the price will form a new lower low. This is compulsory. If they are not serious sellers, the price will fail to form a new lower low. So you see here, it came down, it couldn't form a new lower low. Now it formed a new lower low. So once we see that the signature of the bear is in place, and the price form a new lower low, now we are expecting a rally up. We want it to rally up. Generally, Fibonacci traders will apply Fibonacci retracement. Here it is. As you see, from a new lower low, it starts changing direction here. You can apply Fibonacci retracement to this session, and you want to draw higher at which level? The 50% level. The 50% Fibonacci retracement level. You see, that's where the price did stop. Why? Because the 50% Fibonacci retracement level divide the price action into two zones, the zone above bullish, the zone below bearish. Sometimes the rally may not reach the 50% level, but most of the time, as you can see here, that's where it did stop. You can also combine the rally with the minimum price move, which is free, which is good for us. We see the signature of the bear, we say, all right, if they are serious seller, let them give us the first new lower low. Here it is. The new lower low is indicating to us that the bearish momentum is increasing. Now, I just finished to record one video that I was talking about before, which is the most powerful bullish trading signal. So once we see, this is something else, check it out, okay? Once we see this new lower low, we are now waiting for the first lower high. You need to be very patient. So you want it to go up. You want to sell. Now you want it to go back up. You can use Fibonacci retracement to help you to see which Fibonacci retracement level is going to hit. We will prefer it to be stuck below the 50% Fibonacci retracement level. Sometimes the price may not do that. Like you see here, it's a beautiful set. I did 1, 2, 3. If you sell like this, now you see the double, you see the first lower high, you implement your top-down trading method like a professional trader. We are on a weekly chart, so we say weekly chart trading setup, 4-hour time frame or 2-hour time frame for the signal, and a 15-minute time frame for the entry. All right. If you don't want to enter the 15-minute time frame, we can break it down all the way to the 3-minute time frame, which means the 2-hour time frame or the 4-hour time frame signal. We'll use it again as a trading setup, and we say 4-hour time frame, 15-minute time frame, 3 minutes or 5 minutes for the entry. So the point I'm making here is that generally trader will see the signature of the bear, double top, plus a surge in trading volume. Sometimes they probably do all sorts of things they are taking out, or whether they are swing trading, day trading, and they are taking out and they want to forget it, all right? But just be patient. Adopt a conservative approach, wait for the first low high. The reason is sometimes traders leave money on the table. This is the point. They are leaving money on the table. So they see the signal to the bear and they don't take advantage of it. They walk away, or some trade happen to be a losing trade. Here it is, be ready to sell each time you see, okay, a lower high. Here it is. There's another one here. That's another lower high. So the signature of the bear was here. Now we see the first lower high. Sometimes people will sell only here. And they walk away. They walk away. They forget about it. And they will go and take another useless trade. And they end up losing. Instead of taking advantage of the signature of the bear or the signature of the bull, you want to do it properly. So now that we apply Fibonacci retracement to the first move, 50% level, now if we apply a top down trending method here, we sell it down. If it form here, it did not form a new lower low, you can see, because in the downtrend we want it to form a new lower low. Look carefully here, it did not form a new lower low, so we'll be wondering what's going on. So here it formed equal low. We need to be careful. If it form an equal low, it's not very encouraging to bearish traders. But here it is, it rally up again and form a lower high after this common settle is kaput. But if you are selling like this here, you need to be careful because it did not form a new lower low. But suppose you were here, what you can do again, I don't want the video to be too long. You can use again Fibonacci retracement to this move here. You see this rally up is after this move down, so you can apply Fibonacci retracement to the move from here to here, because this is another rally. You want to highlight which level. Now it went up to the 61.8% Fibonacci retracement level, so you want it to come back down below the 50% level, which is the line below. You see here, you see what has, it's beautiful. The beautiful traders here, see. So the first line here is the 61.8% level. That's where the second rally ends. That's the orange line there. The professional push it down below the 50% level, the 50% Fibonacci retracement level. That's the pink line there. Oops. So that the pink one is the 50%, the orange is the 61.8%. They push it below the 50% level because the 50% level, 50% Fibonacci retracement level, is dividing the price action, this move down, into two zones, bullish above and bearish below. So they push it back down below the 50% level. Look, it retests it. So it break below the 50% level, retest it here. This is your setup there. Your bearish setup. You see how they sold it down? Alright. So if you were here again, it came down like this because the signature of the bear is there, all right, still in place. So it came down again. So you say, okay, I want to sell again. I want to sell again for the. So you will apply again Fibonacci. Hold on, please. Let me clear my line. You can apply again Fibonacci retracement to this move here, down to this level here, and you are waiting for your rally into a Fibonacci retracement level. Now you can see that it went to the 61.8% level again, right there. Look carefully. Move it down. That's the 61.8% level. So after this move down, we apply Fibonacci retracement. It rally up to the, all right, the 61.8% level. So normally the professional should push it down again below the 50% level. But as they push it down, it finds a support on the 50% level. That's why you see it formed a double bottom chart pattern, okay, on the 50% level. And from there, it just went away. Anytime you see a double bottom or a bullish chart pattern in the 50% Fibonacci retracement level, it's usually a high probability trading setup. But you have to have a good reason, which is the signature of the bear, a double top with a surge in trend volume on the right hand side. Now you are looking for your lower high, and you are implementing a top-down trading method and using a Fibonacci retracement. Wait for that rally, wait for the common settle to be kaput, implement a top-down trading method to trade it. We can do the opposite also for the signature of the bull, price from a double bottom chart pattern, and we see a surge in trading volume on the right-hand side bottom, all right, and you can trade it straight away, or you can wait for the first higher low, all right. First higher low for the bullish setup, and then you implement a top-down trading method to trade it, using again the Fibonacci retracement to pinpoint, okay, the 50% Fibonacci retracement level, waiting for a pullback into the 50% Fibonacci retracement level. All right. So this is the end of this tutorial. I want to keep it short, but now 40 minutes, so we will wrap it up. So if you have any question or suggestion, put in the comment section, and in due course I will be recording another video to answer your specific question. All right. If you find this video truly useful, let us know, okay, by giving us the thumbs up. If you think that this is another disgusting, useless video, please let us know by giving us the thumbs down. This will put us under pressure to improve our next recording. All right. If you find it truly amazing, feel free to share with your friend on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We had a TSTW24 traders talking about what? All right. Stock market trader explain the signature of the bearish traders. Happy trading to you all and speak to you soon.